Well, I think that the bond market may be starting to give you a bit of a signal with the fact that, we had that jumbo rate cut out of the Fed, and the 10-year Treasury note yield is up at least 10 basis points from that meeting. And that's pretty unusual. You would have thought that fixed income would have rallied, but it's sold off. And of course, as you just said, it looks like both Trump and especially Harris are going to unveil even more economic agenda. And the economic agenda is basically there to buy votes and buy votes through giving more candy to the citizenry out there. So I think that the bond market in particular might start doing some math as to what are the fiscal deficit implications of layering on all the stimulus. And then at the same time, for all the banter about trying to sustain the downward trend in inflation, how does fiscal stimulus on the part of both candidates, play into that and possibly complicate, the Fed's move to continue to cut interest rates?
Well, we know that Americans, they vote with their wallets. They vote on the economy increasingly. So let's talk about the economy. Let's talk about the labor market, because we got some Fed speak already this morning, hearing from Kashkari saying that he backs another half point of Fed cuts this year, basically saying that the balance of risks has shifted away from inflation and more towards the labor market. We also heard from Raphael Bostic saying that that large cut that we saw last week, it should support the labor market from here. So clearly, of course, you have Fed members concerned about weakening here, concerned about the labor market. How are you viewing the balance of risks, David?
Well, I would fully concur that the labor market has emerged as a more principal risk than inflation. I'll say, inflation is never really dead, but it certainly is dormant, and all the leading indicators are pointing south. As far as the job market's concerned, a lot of the macro bulls out there only focus on one thing, and it's initial jobless claims remaining so low. And there's no doubt that layoffs and firings are still at very low levels. But I think what's caught the Fed's eye is the true leading indicator in the labor market, which is the hiring rate. And they've been like a hot knife through butter. And the hiring rate is starting to decline significantly, to the point where if things start to turn worse for the economy, all of a sudden, you're going to start to see negative readings on non-farm payrolls. That hasn't happened yet, obviously, because the firing rate's been so low. Companies are still hoarding labor. But the hiring rate, I think, is what's really caught the Fed's eye, and it's declining precipitously over the course of the past 6 to 12 months.
David, I want to get your view here on how choppy the off-ramp is here when we think about the Fed cycle, their ability to cut rates, but then realize also that there's a lag between when they cut rates and it impacts the real economy. With that in mind, how choppy could the next year get when it comes to employment, when it comes to growth?
Well, you mentioned quite accurately what's going to be influencing the economy for at least the next 6 months, maybe even 12 months, is the lagged impact of all the damage the Fed has done when it was busy fighting inflation. So everybody's all excited that the Fed has now started to cut interest rates, but that might only start to really influence the economy in a positive way in 2026. And 2025 will be the year where we continue to see the lags from the Volcker-like rate hikes percolating through the economy. The best example is that, the Fed under Bernanke and Greenspan, they raised rates almost the same as they did this cycle under Powell. And then all of a sudden they go on pause in the summer of 2006. We go in 2007. Nothing seems to be breaking apart. We have the soft landing narrative that went all the way into 2008. But remember that the Fed thought it was moving preemptively. The Fed first started cutting interest rates in summer and fall of 2007. That was well before Bear Stearns, well before Lehman. And everybody thought, well, they're cutting rates in the summer, fall of '07, and we're going to breathe a big sigh of relief in '08. Remember, in '08, right up until Lehman collapsed, soft landing was everywhere, like we're hearing right now. But you see, what happened in '08 was we were still feeding off the lags of everything the Fed had done in '06, in '05, '06, and the lagged impact took over in a whole bunch of different ways. The economy and the markets into 2008, nobody saw that happening. the Fed cuts interest rates, they radically embark on quantitative easing, and then we got a recovery, really starting later in 2009, 2010. And that's how the cycle moves. Interest rates are a leading indicator, but they do operate with long lags.
Well,
and this lag this time around was super long because of all the fiscal stimulus that got in the way. But that's in the rearview mirror right now. So I think that the lags work in both directions. And I think that, people are going to say the Fed's not behind the curve. The yield curve's been telling us that the Fed's been behind the economic curve for a long period of time. It's not evident in the coincident economic data that everybody's paying attention to, but the leading indicators are certainly pointing to a very rough year for the economy
but
in
David,
2025.
I got to wonder, if you see hiring headed down right now, right, at a time when the U.S. is finally, clamping down on border crossings, on immigration, doesn't the labor market start to tighten up at a time when the Fed is cutting rates? Isn't there a chance that inflation could come roaring back, especially if we get President Trump in the White House and he starts to put on tariffs, starts to export, immigrants, workers, and continues to cut taxes?
Well, fair enough. Look, we heard a lot of this when Trump got elected the first time in 2016. Tariffs, of course, this time his plan is, tariffs on steroids. But the part about immigrant labor, you're 100% right that he built that wall around immigration in his first 4 years, and we finished off that cycle with the unemployment rate before COVID, getting to roughly 3.5%. And there was no big wage spiral, and there was no big inflation spiral. And it just goes to show it's not saying that immigration isn't important when you're modeling out the impact on wages and inflation. But there's so many other things that go into any econometric model trying to predict these things. The point here is that you're 100% right. Ipso facto, we create tighter curbs on immigration. It is going to constrict labor supply. That's a no-brainer. But what's happening right now that is going to provide a more overwhelming impact on the labor market is that businesses in America are cutting their hiring rates dramatically. The hiring rate right now is 3.5%. It's actually lower, not just lower than it was pre-COVID. It's lower than it's been in the previous recessions going back the past 3 decades. Mm-hmm. So that has nothing to do with anything we're talking about. Yes, it will constrict the supply of labor, but what's going to happen that's going to be overwhelming to that supply constriction you're talking about is the demand for labor is going to be falling at a faster rate. And that's already starting to happen, which is why wage growth has started to subside.